On November 1st, the Federal Reserve Bank will begin their next meeting. And then on November 2nd, the Federal Reserve Bank will announce what changes they want to make to interest rates in response to the newest inflation report and in response to the newest jobs report. This is the balancing act that the Federal Reserve Bank is playing, where when you have high inflation, the Federal Reserve Bank is more likely to raise interest rates. And when you have a strong jobs report, meaning when more people have jobs, they are more likely to raise interest rates as well, because that's an indication to the Federal Reserve Bank that the economy is strong. Well, our latest jobs report, which came out in October, told us that in September, the unemployment rate fell to 3.5%, which is some of the lowest unemployment rates ever. And this is much lower than expected. They were expecting unemployment rates to go up to 3.7%, when in actuality, according to their data, unemployment numbers fell to 3.5%. So a very strong jobs report, and at the same time, inflation came in at 8.2%. It was expected to be 8.1%, so inflation is hotter than expected. And the Federal Reserve Bank actually looks at not the CPI data, which is what this is. CPI is the Consumer Price Index. That's the broad inflation level that you hear. But the Federal Reserve Bank likes to look at something called the core inflation index. Core inflation is when you take this CPI data, which is the broad inflation number, you take out what they call the volatile inflation numbers. So they take out energy, they take out food costs, and that's where you get the core inflation data. And the Federal Reserve Bank has said that they like looking at core inflation numbers, not the CPI number. Well, in October, we got the last core inflation data numbers, and it turns out that core inflation came in at 6.6% for the last year, which is the highest core inflation data that we have seen in 4 decades. This just broke a new record high, and it's higher than what was expected. It was expected to come in at 6.5%, which means now, with the Federal Reserve Bank planning to meet on November 1st and 2nd, they have inflation numbers that are higher than expected. And we have jobs numbers, which, according to their numbers, are better than expected. Remember, this is just what the Federal Reserve Bank is looking at. This doesn't mean that the job market or the economy is stronger or better than expected. This is just the data that the Federal Reserve Bank looks at. This is what they're going to say. Inflation is hot, jobs are even hotter. So, the Federal Reserve Bank will then have more ammunition to raise interest rates. Now, of course, I can't predict what the Federal Reserve Bank is going to do. I'm just telling you the numbers that they look at. They can always change their minds. They can change whatever analysis they want to make. But up until now, this is what they have been saying. They have been saying that they're going to look at this and they're going to compare it against this. And based off these two things, they're going to make a decision on what to do with interest rates. Well, interest rates have an impact in the economy, because when you change interest rates, it changes how expensive buying a home is. It changes how expensive buying a car is. It changes how expensive it is to grow your business. And the more you raise interest rates, well, buying a home becomes more expensive. Buying a car becomes more expensive. Operating your business becomes more expensive. And raising interest rates then affects home prices, because when mortgage rates go up, like we've been seeing happen, less people buy homes. When less people buy homes, home prices start coming down. We've been seeing home prices start trickling down. They haven't really come down very aggressively, but they've started slightly to come down in some areas. Same with stock prices. When interest rates go up, borrowing money becomes more expensive for corporations. And right now we have so much corporate debt. Corporations loaded up on debt in the last number of years. And now the cost of servicing this debt is going up because their interest rates aren't a fixed rate 30-year mortgage. And so as interest rates adjust, well, now businesses have to pay more money to service their debts, and borrowing more money becomes incredibly more expensive. So the cost of business goes up, which makes the stock prices go down. And so you're seeing the prices of assets start to fall. This is why many investors have been saying, Federal Reserve Bank, you need to stop raising interest rates. It's hurting businesses. It's hurting real estate prices. But this is where now the Federal Reserve Bank is going to have to make a decision. Who do you want to help? Who do you want to hurt? Because raising interest rates are going to hurt some, it's going to benefit others. Just like that, cutting interest rates is going to hurt some and it's going to benefit others. And everybody's going to have their own opinion. Like if you have money in the market, you're going to love to see cutting interest rates because, well, if you cut interest rates, you're going to see a boom in the stock market. If you have money on the sidelines, well, Well, you're going to want to see interest rates rise because that's going to push asset prices lower, which will make it more attractive for you to take your cash to go out and actually buy these investments. You have a lot of people betting with their money on what the Federal Reserve Bank is going to do. You have people betting and trading money in the markets based off of what they expect the Fed to do. That some people expect the Fed to start cutting interest rates next year. Some people expect the Federal Reserve Bank to raise interest rates by 0.75%. But this is where I don't want you to get into the game of trying to bet what the Fed does and not try to fight the Fed, because the reality is there's no way to predict what the Federal Reserve Bank is going to do, when they'll change their minds. We don't know if they're going to raise interest rates by 0.5%, 0.75%, or 1%. What we do know is this is the game that they're playing. They're watching this balancing act right here. And as an investor, what you got to understand is that bringing inflation down is going to take effort. It's going to take some pain to the economy. And yes, we are seeing pain to the economy, but the Federal Reserve Bank has said that one of the things that they want to do is that they want to soften the labor market. They want to see asset prices come down. They want to see inflation come down. And this is going to seem weird. Why would you want to soften the labor market? Because that means people have to lose their jobs. Well, this is what the Federal Reserve Bank says would be proof that the inflation fight is working. And so this is where you got to understand that there is economic pain ahead, and this creates opportunities for investors. Now, before I go into what this means for you, if you do want to stay up to date on what's happening, if you want to know what the Federal Reserve Bank does when they do it, if you want to stay up to date with all of these things, you have to join something like Market Briefs. It's a free resource that I created. It's a completely free newsletter where every day my team is breaking down what's happening with things like inflation and the economy, the global economy, the stock market, the real estate market, and cryptocurrency into a fun, witty, and easy to read email. I promise, even if you don't have any sort of financial background, you're going to love reading Market Briefs. And the best part is you can read it in less than 5 minutes every morning, and it's free. So if you haven't joined Market Briefs yet, I got the link to how you can join for free down in the description below. The thing is, interest rates have grown so quickly in 2022 that our economy really hasn't had a chance to absorb the effects of these higher interest rates yet. Like in the beginning part of 2022, if you wanted to go and get a mortgage, it was going to cost you less than 3% a year. Now we're at above 7% a year. And so you got to understand that when somebody lists a home, for example, for a sale, that they're not going to just immediately start cutting the prices of their homes. They're going to be very hesitant to cutting the prices of their homes. If you told a seller that I'll pay you more for their home, they'll more than happily accept the more price, but they're not as willing to accept a lesser price. And so when you see the prices of the higher interest rates and the effects of these higher interest rates, it takes more time for it to be absorbed into the economy. And while people are trying to digest these higher interest rates keep going higher and higher and higher. And this is where you got to understand that the effects of these higher interest rates isn't just when the interest rate goes up. It's what happens 6 months, 9 months, and 12 months after the interest rate goes up, because that's when the effects of the higher interest rates get absorbed into the economy. And I gave you an example of just a small factor in the housing market, but the same logic applies to all different types of debt, because you have corporations that have trillions of dollars worth of debt outstanding right now. And as the interest rates on this debt starts to readjust, and now corporations have to pay significantly higher interest rates, 2 to 3 times higher interest rates than what they were before, well, that's going to affect the expenses that businesses have to pay. And if that's happening at the same time that corporate revenues are falling because the economy is slowing, well, you can expect that's going to lead to more layoffs because corporations are going to want to make cuts. Every single thing takes time to process and to flow through the economy. It's not an instant change, like how people expect inflation to just instantly go away. It's going to take pain. It's going to take actual changes. In the beginning part of 2022, even in 2021, even in 2020, I was talking about how inflation was going to have a major impact onto the economy. And that inflation doesn't just magically go away because the Federal Reserve Bank doesn't have fairy dust that can make inflation just magically disappear. Which means that if we want inflation to go down, it's going to take time and it's going to take an actual pulling cash out of the economy. One way of doing that is by raising interest rates. And the Federal Reserve Bank is going to have to get aggressive and stay aggressive to raise interest rates to bring inflation down from 8 point some percent down to their 2% goal, because that is a long way to go. And on top of that, the Federal Reserve Bank still hasn't really ramped up their balance sheet selling. We've seen some improvement in the Federal Reserve Bank balance sheet, but we haven't seen a major dip in their balance sheet, which means that the Federal Reserve Bank has all these assets and all these bonds on their book that they want to start selling and putting into the market. But if that happens at a time where asset prices are falling and the economy is slowing, that would further push the economy slower. And this is where, like I've been saying, the Federal Reserve Bank is going to have to make a decision. What do? Do you want to fight inflation, or do you want to fight a slowing economy? Because you can't do both at the same time. The way you fight a slowing economy, we've seen this happen for decades in the past, is through inflation. You cut interest rates and you print money. That's how the Federal Reserve Bank has been able to fight slowing economies. That's how they've been able to fight slowing asset prices. But now we're seeing the slowing economy, we're seeing slowing asset prices, but we already have high inflation. So the Fed can't start inflating the slowing economy because that would cause more inflation. Well, I guess they could, but the consequences, we're going to have higher inflation. And the problem is that this high inflation is causing a slowdown in the economy. Sure, people have jobs, but a lot of people are not satisfied with their jobs, and the cost of living is growing so quickly that people's incomes are just not enough to cut it. And so this is where the Federal Reserve Bank is saying that we want to bring inflation down at whatever cost it takes, because if we don't bring inflation down, it's going to cause much more pain to the economy long term. And that's why the Fed says, brace for pain, get ready, because this inflation fight is going to hurt. And this is where you want to be aware of what's happening. That way you can capitalize on the opportunities, because the reality is, if this fight on inflation does continue to hurt the economy, if it continues to hurt asset prices, that creates opportunity for you to come in and purchase some of these assets, stocks, real estate, crypto at a discounted price, but it requires you to be financially educated and prepared. And this is where you want to be aware of what's happening. That way you can make smarter decisions with your money. And that's what Market Briefs aims to do. It's a free resource to help you stay up to date on what's happening. That way you can make smart decisions with your money. 2022 is when we really started to see things change in the housing market. When it comes to mortgage rates, we saw mortgage rates go from about 3% in the beginning part of 2022 to about 7%, almost 7% today at the time of me recording my video. So we have seen mortgage rates more than double in this year